as always with investing, the number one decision to make is, what is my asset allocation? It's the key to achieving your investment goals. So what do we mean by asset allocation? Well, asset allocation is the spread of your investments across the various asset classes. And I call those asset classes the 5 B's of investing. And an asset class is really just a group of assets that behaves broadly similarly. And so starting at the most defensive, that is the ones that smooth out the bumps in your portfolio's growth, deliver, remove volatility, and deliver more certainty. So the safest in that context is bills or cash. And whilst they are very stable, they're generally not able to deliver a return greater than inflation over the long term. And that's a problem if we're trying to create, for example, retirement income, or we're saving for long periods. Stepping up the next notch, the next B of bonds. Bonds are really loans to governments or corporates. And in this context, when we're talking about defensive assets, we're talking about the higher grade ones. So that is ones to creditworthy governments or high quality corporates. And they're generally described in terms of credit ratings. So you've probably heard the expression AAA, AA, single A, B. That's a measure of the credit rating. And the higher the credit rating, the lower return, but the more stability you get and the greater certainty you have of getting your money back. The third B, the third defensive B, is bullion. And that's code for commodities, but for most individual investors, that means gold. And so they're the 3 defensive Bs. But moving on to the growth stage, we've got bricks and businesses. So bricks is real estate and infrastructure. Businesses are companies, so shares in companies or equities. And bricks and businesses are growth, bills, bonds, and bullion are defensive. And we need a mixture of all of these in our portfolios to deliver our investment goals. So the growth ones are there to deliver higher returns, but they generally come with more variability and the chance of losing money. But they are capable of delivering returns above inflation over time. So a significant part of our portfolio needs to be in these growth assets. And to some extent, we need to just get used to volatility. The alternative or the supplement is defensive, and that's really where we're going to focus tonight. These are more likely to generate lower returns, but with a low risk of losing money over the long term. These are things that allow you to sleep at night and help keep your hands off the sell button when markets get turbulent.